we're going to be talking about Chapter 9 today in this screencast. And what Chapter 9 is about is basically business income and deductions and accounting methods. Now, I know that you guys, many of you, are really strong in the accounting side of things. We have CPAs in the class and MBAs in the class. So I will spend a little time on the accounting methods. It'll probably be a rehash for some of you, but I won't spend a lot of time on that. So the upfront stuff, I want to talk about the tax aspects of business income and deductions. So that's where we're heading. Okay, first thing, business deductions are authorized by Internal Revenue Code Section 162. 162 is very broad. If you pull up the code section itself and read it, it's very broad and it has fuzzy language in it. Shocker, right? An IRC code that has code section that has a fuzzy language in it? Well, it does. And congressional intent behind Section 162 was for taxable income to really reflect the net increase in wealth from a business. So businesses get to deduct expenses incurred to generate business income. And so what you're left with, if I've got income and I've got expenses deducted against it, what I'm left with is taxable income that really represents the net increase in wealth that I have. And that was Congress's intent in enacting 162. The important language that you need to remember in terms of 162 is the language regarding carrying on a trade or business for profit. If you're not doing that in the eyes of the IRS, if you're not really carrying on a business, a trade or business for profit, if you're really not doing that, then what you have in the eyes of the IRS is a hobby. And you can still record income from your hobby and put that on your tax return, but the difference is in the expense side of the things. Expenses for a hobby are taken on Schedule A, and if you guys have seen Schedule A of your own income tax returns, I'm assuming some of you itemize and use Schedule A, is that it's subject to an adjusted gross income floor, usually around 2%, which means that your expenses are limited by that floor, unlike business expenses. So the IRS says, yeah, we'll let you pick up income. Nice of them to let us do that. And we'll let you take expenses, but we're going to subject it to a floor if you've got a hobby business and you're really not out there to try and gain wealth from conducting a trade or business. The sister provision for 162 is Section 212, and I won't get into Section 212 in this screencast, but 212 is basically designed to be a sister to 162 for rental and investment income issues. So if you have rental property or you have investment income where you generate income from that, 212 will be what you're looking to figure out what you can deduct. Okay, business income and deductions, ordinary and necessary expenses are deductible. They have to be connected to your business activity. So what does that mean? An ordinary expense is one that's normal or appropriate for the business. A necessary expense is one that is helpful or conducive to the business activity that you're doing. So ordinary expense, normal thing, nothing unusual there. Necessary expense, well, we spend the money because it helps us, it's conducive to our business, okay? But the expenditure for a necessary expense doesn't need to be essential or indispensable. So what am I talking about? Generally, when you're talking about ordinary and necessary business expenses, reasonable, you have to put a certain aura of reasonableness around the expense. So that means the aura of reasonableness means that it's not extravagant. You're not going over and above what other people would do or other businesses would do. And the measuring stick that the IRS uses for this is an arm's length transaction. And there's an example in your book that I think is pretty good where a guy who's running a lawn service has been paying everybody the equivalent of about what would be $30,000 a year. Everybody meaning his employees, about $30,000 a year. Then he hires his brother, and he pays his brother $45,000 a year for doing the same job the other employees were doing. The IRS would look at that and say, okay, in an arm's length transaction, we saw what this job pays. And the arm's length transaction was how a non-related employee got paid by the owner. That's arm's length. There's no connection there. But the brother, all of a sudden, for doing the same job, makes $15,000 more. And the IRS would construe that as not an ordinary expense. And probably not necessary either. So they would construe it as not ordinary and not necessary. And what they would say is $15,000 of that is over and above what you've paid everybody else. So we're not going to let you take that as a salary expense for your business. Okay, something else that is important about ordinary and necessary business expenses. A business expense doesn't have to be typical, and it doesn't have to be repetitive to be considered ordinary and necessary. Let me say that again. A business expense doesn't have to be typical, and it doesn't have to be repetitive to be ordinary. What am I talking about? An example for you would be United Airlines. We all know the story just recently of United Airlines and what happened when they hauled a fellow off the plane that didn't want to get off and wound up getting hell beat out of him by the people that were, by law enforcement and the people that were working for United. And then you've seen, I'm sure all of you have seen the video of the man being drug off the plane. Well, what happens then in that situation is he lawyers up, he gets a lawyer, and the lawyer says, we're going to sue you like crazy for what you just did. United makes an agreement with the lawyer and with the plaintiff, and they work out a deal, and there's a payment made for the pain and suffering of this individual. What happens is that's not a normal expense that you would typically run into, but is it ordinary and necessary in the running of the airline business that United's involved with? Yeah, it is. It's a settlement of a lawsuit. And so is it deductible? Yes, it would be deductible. Now, on the other side, and we won't get into this, how that passenger must account for that settlement is a different story, and the tax liability that that passenger probably has on the other end of this. But anyway, for our purposes, it's a payment by United. It's not repetitive. They're hopeful of that. And it's not typical, but it's still deductible. Okay? All right. Statutory limits on business expense deductions. We talked about this, or we're still talking about it, in our discussion section. I brought up the idea of public policy, and the reason I brought that discussion question into the class is I wanted you guys to get a feel for the fact that tax isn't this jungle of rules and regulations that people have to walk through and hack their way through to figure things out. Yeah, it is. But in addition to that, it's really an instrument of public policy. And there has been a continuing debate about taxes and the tax code being used to modify companies and people's behavior. And whether you agree or not, it has happened. It's certainly happened with overseas activities. When corporations keep money offshore, that's a behavioral change precipitated by the tax code and what it would do to those companies if they brought income back into the United States. So they don't do it. The example that I have here on the slide, fines and bribes. If you're working overseas, you're an overseas corporation, and we all know this, we're not naive, that many parts of the world, bribery is just a part of doing business. It's the way things get done. You grease the skids. Well, the IRS says, you're not getting any deduction for that. Even if you try and disguise the payment, we'll figure it out. And there's no deduction for that. And you're probably going to get slapped with a penalty for that. And you're not going to get a deduction for that either. And just as an aside, you're also, if you're bribing foreign officials, you're in violation of the Foreign Corrupt Practices Act. And you could wind up going to prison for that. So the United States, and again, I think it's something that we could discuss in class. But what it really does is the United States tries to modify behavior through the laws and regulations, Foreign Corrupt Practices, the IRC code. All of these are ways that Congress, in a way, has said, if it's illegal, or unethical type behavior, we're going to modify it through the legalities that we put in place. Okay? Also, no deductions for lobbying expenditures or political contributions. Why? Again, the government doesn't want to seem like they're subsidizing taxpayers' efforts to impact politics. If we gave you, if it was part of the code that you got a deduction for lobbying expenses or political contributions, wouldn't that be an incentive to even spend more on those things? And Congress says, yeah, sure it would be. And so what happens is we would be incentivizing the ability of taxpayers to modify politics, to change politics, and we don't want to do that. So those are some of the things that are expenses against public policy. What else? Other things that you can't get a business expense deduction for. Expenses related to tax-exempt income. There's no deduction for that. Interest on a loan where the proceeds are invested in municipal bonds, for example. Why? What makes sense of that? Well, if you invest your income in municipal bonds, the income that you generate from those bonds, you're not going to pay tax on it. So again, congressional thinking is if you're not paying tax on the income, we're certainly not going to give you a deduction on the other side for generating that kind of income. So that's the thinking there behind expenses related to tax-exempt income. How about key man insurance? If you don't know what that is, key man insurance, most corporations, and I think this is probably true, if they have somebody that's really valuable and they're senior executives, many of them, as you guys know, are paid in the millions and millions of dollars. So they're considered key men or key women or key persons, whatever the appropriate term is. And many times those key persons have to travel around the world for business. Highly paid, highly competent, highly intelligent, highly needed key people that are traveling for a company. And I have a friend of mine, for example, just to give you an example on this, who worked for Carrier, and I might have mentioned it before, maybe I didn't, but he was a senior executive for Carrier. He's the one, and the reason maybe I didn't, is responsible for Carrier's first move to Mexico. He was the one that opened their Mexican plant and had to lay off a lot of workers here in the United States. He traveled constantly. He was 3 out of 5 days he was on the road somewhere. So Carrier, because he was a highly compensated individual and important to their business, got a key man insurance policy on him so that in case the plane crashed or something happened to him, Carrier would be compensated for his loss. So what happens is they're paying premiums on that insurance, and under the Internal Revenue Code, the Internal Revenue Code doesn't give a deduction for that kind of expenditure. If you're paying a large company with an important person that you're trying to insure, and the company is the beneficiary of the policy, you won't get a deduction for the premiums you're paying. But here's the catcher. Here's the good part about it. Well, kind of a good part. Even though you don't get the expenditure for the premiums that you're paying, if that key person is in fact terminated in some way, is killed in some way, whether it be a plane crash or whatever, then the company gets the settlement from the insurance for that. That is also not taxable. So if the company collects a settlement based on the death of a key person, that's not taxable. Okay? Okay, capital expenditures. There's usually no expense on that. What happens is if you have an asset, you buy property, plant, and equipment, and the expected life of that is longer than 1 year, you're going to be forced to capitalize that and depreciate it or amortize it. You're not going to be able to expense it. The general rule is on that is you have to capitalize or amortize. You can't expense if the lifetime of that product or of that property, plant, and equipment is longer than a year. What else can't you get a deduction for? Personal expenses. If you're going and eating lunch every day at noontime from your company and you're trying to deduct your lunch expense, you can't. It's a personal expense. Now, there are some exceptions to this. Let's say you're a police officer. As a police officer, most of the police officers that I've ever known would, the municipalities will require police officers to buy their uniforms themselves, buy their shoes and footwear themselves. Many municipalities require the officer to buy his or her weapon themselves, those expenditures then, because they're required for your job, do become deductible. But here's the only catch on that. Now, there's always a catch in the Internal Revenue Code, you guys. The catch is if whatever the clothing is, yes, it's deductible if it's required for your job, unless that same clothing can be used on the street for everyday wear. So, for example, let's say you're a concierge in a hotel, and at the hotel you're required to wear a suit and tie. The chances are that if that suit and tie doesn't have any special logos for the hotel or whatever, you're not going to be able to get a deduction for that, even though it's a requirement of your job that you show up every day in a suit and tie or a suit dress, because you can wear it on the outside. You can wear it other places, and so you lose the deductibility of it. Okay. Another type of business deduction are mixed motive expenditures. Mixed motive expenditures are motivated by both personal and business concerns. And this is an area I can tell you that attracts more IRS attention than you can believe, but after I explain what it is, you'll understand why. Mixed motive expenditures are a good, if you take a lot of those or they're big numbers, there's a really good chance that you're going to be audited. And what these are, well, first of all, let's talk about the biggie. Meals. Meals and entertainment are the biggies. People in business take others to lunch. They entertain others all the time. And they want to take deductions for that. They want to expense those items. The corporation wants to expense those items because they're typically the ones who, if you're using your corporation's credit card to pay for those, that's an expense for them. The IRS says this: only 50% of business meals and entertainments are deductible. Only 50% of your meals and entertainment are deductible. And to deduct any portion of the cost of a meal as a business expense, the amount has to be reasonable. Okay, number one. So if you're going to deduct it, first of all, you're only going to get, for whatever that meal costs, you're only going to get 50% of it, first of all. So let's say we have a big executive and he or she takes a client out. Let's take a lawyer. Let's make him a tax lawyer. Tax lawyer takes a client out, a potential client, spends $500 on a night entertaining this client, great food, great wine, maybe some kind of show after the dinner. And first of all, what the IRS is going to say is, okay, 50% of that $500 that you spent is, if whatever portion of it is on meals, you only get 50% of it. Okay? And to be able to do that, the expense must be reasonable. Now, if it's you as the tax lawyer and this one client, two people, and you wind up spending $500 for a night, for a night on the town entertaining, is that reasonable? Now you can see where the gray area starts to come in. In Denver nowadays, with the cost of living rising like crazy in Denver, maybe at a good restaurant, $500 is reasonable, although it sounds still pretty high to me. And you're going to be under the obligation as the person who made the expenditure and took the deduction of explaining why this is reasonable. And remember my arm's length transaction rule. The IRS will be looking at situations like this saying, that's two people, $500, it's crazy. Okay, what else? What's another rule? The taxpayer has to be present when the meal is furnished. So you have to be there if you're going to try and deduct the expense. And lastly, the meal must be associated with the active conduct of the taxpayer's business. So somewhere in the evening, we just didn't laugh it up and have a good meal and talk about the weather. Somewhere during that meal, we talked about taxes, and we talked about the client's business, and we talked about what we could do to maybe save that client some money or tax planning or whatever. But business was conducted during that meal to be able to get anywhere close to be deductibility. Okay, so that's a meal. What else? Let's talk about entertainment. Only 50%, again, of entertainment expenses are deductible. Expenditures that are motivated, especially expenditures that are motivated by personal and business concerns, we're only going to give you 50% on those entertainment expenses. and to deduct any portion of the cost of entertainment as a business expense. Again, we've got the reasonableness standard. Business associates have to be entertained, and business associates is defined. It's in the regs. Business associates, what it describes, the tax code, is people that you expect to get business from, people that you're doing business with. It's not just, hey, I took Aunt Sally out to dinner, and I'm going to call her a business associate. No, it has to be somebody that you legitimately expect to get business from. Okay? And again, the active conduct of taxpayers' business has to be involved with that. So you can see how those gray areas can pop up when you're talking about deductions. Business deductions for meals and entertainment. It's really can be iffy. And if the numbers are too big, like I said, I can guarantee you're going to pull an audit on that. Okay. Another mixed motive expenditure. Travel and transportation. In general, travel and transportation, general rule, is deductible. But again, if it's a mixed activity, mixed meaning business and personal, then things change. And how does that happen? Well, if I run a business and I'm going to a seminar, well, I'm a professor, okay, and there's a conference somewhere in the country about taxes. So I attend that conference by myself. I don't bring any family members, anything. I fly to the conference. Let's say it's in Chicago, and I fly back. And during that time, I stayed in a hotel and I had meals. Again, the travel, the transportation piece of it is probably going to be deductible. The meals, again, fall under the same regulations I just talked about. But in general, the transportation back and forth, I get a deduction for the airfare there. Okay, or not me, but Regis would get the deduction. Okay, this area has a lot of questions again with it, when just like meals and entertainment, because taxpayers argue with the service about the mixed motive. So when you're talking about going somewhere and you bring your family with you, let's say there's a conference in Disneyland, and you're thinking about going, and you decide to bring your spouse with you, your kids with you, and the conference runs for 3 days, but during that time you're out with the spouse and the kids, riding around Disneyland, having seen things. You better keep good records. You better keep good records, because if you want to deduct part of that trip, you're going to have to be able to show that that expense was actually business related. Okay, so that's mixed motive expenditures. Let me talk about another one that's important for Colorado. Marijuana. What's the rule on that? What's the rule for that? And I bring it up because marijuana is a growing business. It's huge business in Colorado. And marijuana laws have been relaxed in other states as well, where the sale of marijuana is a going business. And so if anybody in the class is thinking about this business, I thought I would give you at least a little background on what's happening in Colorado regarding the marijuana on both the state and the federal level. States that have legalized marijuana have also subjected marijuana business to a whole bunch of different taxes. And I'll use just Colorado as an example. I know you guys are all over the country, but you might be in states too where it's been legalized. In Colorado, marijuana retailers are required to have a sales tax license, and if it sells both medical and retail marijuana, the business has to have a sales tax license for each type of marijuana that it sells. And even in the medical and retail if medical and retail marijuana are sold at the same location, they still need a sales tax license for each one of those. In addition, if a business is engaged in selling medical marijuana in Colorado, it has to charge a state sales tax plus local sales taxes to be able to make that sale. So as you can tell, just from that, the state of Colorado anticipated that this would be a major boom business in the state of Colorado, as it has proven to be, and the state wants their fair share of taxes for the business, because this has turned in, at least in Colorado, into $1 billion business, and so the state wants its cut. Okay, that's on the state level, and it's pretty similar throughout all the states that have approved marijuana sales, legalized it. How about for federal taxes? For federal taxes, if a business is engaged in the sale of marijuana, it can't take advantage of any of the tax credits or deductions. that I've talked about. Okay? So if you're engaged at the federal, if you're engaged in a marijuana business in Colorado and you hope to take business deductions like I've explained, forget it. It's not going to happen. And you're also not going to get any tax credits for anything that you do. The reasons behind that is a 1982 federal law, which is still enforced by the Internal Revenue Service. And what the Internal Revenue Service, the law that was enacted in 1982, said it bans all deductions and tax credits for the illegal trafficking of drugs. What does that mean? That means in terms of marijuana, marijuana on the federal level is still illegal. Under federal law, it's still illegal. So engaging in the sale of pot is classified as illegal trafficking, just like any other drug. It's illegal trafficking, so there's no deductions there's no expensing, and there's no tax credits in the sale of or in the trafficking of illegal drugs. Okay. Now, what the IRS has done as kind of a break on this is they provided some guidance to marijuana businesses, especially in the state of Colorado, that you can deduct what you can show as part of your cost of goods sold. There is partial deductions for cost of goods sold items, but it's just guidance. What does that mean if it's just guidance? You can't take it as precedent. So you very well, if you do it, could still be getting a visit from the IRS if you take cost of goods sold deductions, because they might say, yeah, you've taken these, and in a way, you're still liable. You're still trafficking in illegal drugs, and so we're still coming after you. So that's marijuana sales. Billion-dollar business in Colorado. I don't know how it is in other states, but I'm sure it's just as big. Okay. Next thing, domestic production activities deduction, DPAD. Domestic production activities production, DPAD. DPAD is an artificial deduction. Artificial deduction that subsidizes domestic manufacturing. And it talks about in Chapter 9, why is it artificial? Because really it doesn't represent a deduction for a real expense. DPAD, there's really no deduction for a real expense. It's just designed by Congress to reduce the tax burden on domestic manufacturers. They want to keep business in the United States. They want to keep people producing products in the United States. So as an inducement for doing that, if you produce a tangible product of some type in the United States and you can allocate a certain amount of your expenses to that product production, then what we're going to do is we're going to give you 9% of the lesser of qualified production activities income or modified adjusted gross income to be able to take as a deduction. Okay? What that really is qualified production activities income, the QPI. A lot of acronyms here. DPAD, QPI. QPI, what it is domestic gross receipts less expenses attributable to domestic production. Whatever that line is, then you take 9% of that, or you look at, and this is where it becomes a pain to do QPI, is if you've got employees, you also have to take and allocate part of their salaries to your production activities, which means you have to figure out, let's say somebody, for example, in marketing, if part of their activities are somehow related to your production, you have to take part of their salary and allocate it to the production and can use that as part of what goes into the calculations for QPI. It's a little complicated to get the benefit of the deduction. And ultimately what you get down to, after you get your 9%, you have to figure out 50% of wages that business paid to employees working in qualified production activities. And that means everything involved with production. Doesn't mean just somebody on an assembly line. It can be other people in the production area or who touch production in some way. You have to figure out what all of their wages are, take 50% of that, and then what you come up with is that's your limitation. You're limited to that no matter what. And if that happens to come out less than qualified production or modified AGI, that's all you get. So it's a complicated, tricky way. DPAD is a complicated, tricky way, depending on your size. And for small companies, it's not so complicated. Of saying, okay, we're going to encourage domestic manufacturing, and so we're going to give you a 9% break on your income for doing that. And that's all it is. It's an artificial deduction that's just there to help American manufacturing. Okay, accounting periods. Now I'm getting into the language that you guys know pretty well, so I'm going to start picking up speed a little bit here. An annual period for accounting is 12 months. You can have a short tax year, which is less than 12 months. A calendar year ends on 12/31. I'm not telling you guys anything you don't know. And for fiscal year, it's the last day of a month, not necessarily December. So that's the counting periods that you can pick. You can pick calendar year or you can pick a fiscal year, I guess is the long and short of it. And you guys are well aware of that. And then there's also 52, 53 week year ends. Some people use those as well. Some companies use those as well, but mostly what you'll get are fiscal years end on a month somewhere different than the end of the year. Okay. How do you do it? How do you pick an accounting period? It's almost dictated for you in a way by choosing an accounting period. For sole proprietors, it's the same. Their accounting period is the same as their proprietorship. Remember, a sole proprietor figures out income and expenses on their business, puts it on Schedule C, and files it with their normal tax return. So their tax year is going to be 12/31. C corporations and individuals can make a choice when they file their first tax return, when the business first goes into effect and they file a tax return that's consistent with whatever their book accounting period is, but they're pretty much stuck with it then. You have to get IRS permission once you pick an accounting period. If you want to change it in some way, you have to get permission to do that. Flow-through entities, they have a required tax year. Most of the time, flow-through entities match it to their employers. Partnerships tend to match it to their partners' tax years as well. But again, you can adjust your accounting period. Accounting methods. Again, now I know I'm really talking and preaching to the choir here because I know you guys all have a background in this. But comparison of financial and tax methods. And this is no news to you, but financial accounting is very conservative. Why? Because financial accounting is used to give to financial information to those people that might have an interest, like stockholders, might have an interest in what the company's doing. And so they want to be conservative. They don't want to overstate income when they're doing financial accounting. They'll recognize losses as quick as they can, but income is very slow to be recognized. And the idea is we don't want to mislead our investors, our stockholders, or if we've got creditors, if we've got loans out there, we don't want to mislead them by looking overly well off, overly wealthy. Now that's financial accounting. Tax accounting is a whole lot different. Tax accounting, we're not as conservative. Those of us who dabble in tax accounting are quick to recognize income if we can, and we're likely to defer deductions. Why? Because we want to try and do things that are going to help us, tax-wise. So we might defer deductions and recognize income now with the hopes that we're going to pick up deductions later. It's just a different mentality. It's a just different way of looking at things. So one side says, we're not going to show income right away. Another side says, yeah, we are going to show income right away. And the reason that we have to do that for tax accounting, it's not so much because we think it's a good idea, but Congress tries to maximize its tax revenues. And so it puts a greater burden to recognize income on the tax accounting side of the house. Overall methods of accounting. Cash, okay, cash method, we all know. You recognize income when received. Accrual method, recognize income when it's earned or received, whichever happens first generally. And then there's a hybrid method that's a mix of both. It's accrual and cash, okay, and you can do that. I'll explain that in a couple of minutes. Okay, the methods, as I said, your accounting methods are adopted with your first tax return, and large corporations, once you've picked the accounting method you're going to use and the year you're going to use, after you filed your first tax return, then you're pretty much stuck. Large corporations are pretty much stuck anyway. They have to use the accrual method. Okay, the cash method for a small business and for even a partnership tends to be a nice way to go. Why? Because you recognize income when you get it, when it's actually in your hand, and expenses are recognized when you're actually writing a check and it's paid. So it's very flexible with the cash method. It's relatively inexpensive to do and maintain a system like that. It's definitely not GAAP because income and expenses don't fall into place right away. There's not good matching. And as I said earlier, for a large corporation, a C corporation, you can't do it. So, but cash method's simple and easy and nice to do. Okay, accrual income. When you talk about an accrual or accrual accounting method, what you're really looking at is income recognized when earned or received. I would underline earned. Okay. What accrual accounting does is uses for tax purposes an all events test, meaning that income is recognized when all the events have occurred which fix the right to receive that income. And you're pretty much accurate on how much you're going to get. Okay, so let me say it again. When all the events have occurred which fix the right to receive income. So you're going to get paid, and I know you know how much you're going to get paid. And businesses meet the all events test in an accrual system at the earliest of these dates. You complete the service that you were hired to complete, or you complete the sale that the thing you were trying to sell. If those things happen, okay, that's one test. When the payment is due from the customer is a second test. And when the payment is received for the service or sale, that one probably never happens. Never, as far as accrual income, is recognized first. So the earliest of those three things, when that happens, you recognize the income. Okay? That's the all events test then. At that point, when the service is done and you've done everything you're supposed to or were hired to do under the all events test, then at that point is when you recognize the income, for example. Or when the customer's supposed to pay you, that's when you recognize the income, not when you actually get it in your hand. So that's the difference between the cash method. Okay. Prepaid income. Advance payments for services. Generally, again, the all events test would require prepaid income to be recognized when you get it, right? You know, that's what we're talking about. Even if you haven't done something yet, when you've gotten an early payment for it from your customer, then you need to recognize it, even though you haven't completed the service yet. But there's an exception under the code that allows you to defer recognition for 1 year, unless you're recognizing that income for your financial records. If you're recognizing that income under GAAP, then for tax purposes you have to recognize the income as well. You can't have a disparity there. But in general, you get a deferring recognition for 1 year after the activity happens if it's not recognized in your financial records. Okay? This doesn't apply to rent or interest income. Those are handled differently. Those are different kinds of animals. Okay. Taxation of prepaid income. Advance payments for goods. Okay, what do you do here? What happens when you have goods stored up and you're getting advance payments for those? You have to elect one of two methods for recognition. Recognize the full inclusion method says any prepayments for your goods that somebody has made to you, you recognize it as income. That's the full inclusion method. Any prepayments that you get for the goods that you're selling under the full inclusion method, you recognize it as income. A deferral method is the second method, and you recognize advance payments for goods by the earlier of when the business would recognize the income tax for tax purposes or when it recognizes it for financial reporting purposes. Okay? So the deferral method says when we start to recognize, and remember, under the accrual method, we're kind of conservative and we're saying, okay, we are going to try and push off the recognition of income. So what happens is it could be a while before that income is recognized on our books, and the IRS isn't going to wait that long. So when you would recognize that income for tax purposes, if that's earlier than when you recognize it on your books, that's when you pay taxes on it. Okay? A little confusing. I know there's a lot. We're in a part of Chapter 9, you guys, where there's a lot of rules and regulations, And I don't want you to get bogged down in the weeds and all this, because it's easy to do. There's this, then that happens, and there's 5 or 6 exceptions. What I basically want you to do is just understand the concepts around this. Now, for stuff that's on the CPA exam, I'll try and put more emphasis on that, or things that I know that tend to show up on the CPA exam. I'll put more time in on that. And I'll tell you that we might need to get down in the weeds on how to calculate certain things so that you're prepared for the exam. But in general, on stuff like this, what I like you to do is just get a general feel for how this works, so that somewhere down the road, because you're not going to remember these rules anyway. That's the thing. I can give you all these rules now in this video, and I know darn well a day from now, an hour from now, after you watch the video, you're not going to remember them. It's just too darn many to stick in your head. The only way that you'll start to remember them is working with them over and over and over again. But I would like you to have a general concept, general idea, so that you know somewhere down the road, if you get a job doing accounting work, and it's your first day on the job, and you've got a client who just got some prepaid income, for example, something might key off in your head to say, wait a minute, maybe I better check this. So that's what my goal is. I'll get down in the weeds with you when I think it's something related to the CPA exam. Otherwise, I'll try and keep you on an upper level. We won't get down in the weeds when I just want you to get concepts. Okay, so I hope that's clear with you. Okay, inventories. How do we handle inventories? When selling inventory constitutes a material income producing factor for your business, it has to account for gross profit, sales minus cost of goods sold, under the accrual method, even if you're a cash method taxpayer. Let me say that again. Inventories are treated a little bit different than everything else. When selling inventory, if that's a material part of your business, we make something, we put it into inventory, and then after we've produced it and put it in inventory for a time, we sell it off. You have to account for your profit, which is your sales minus cost of goods sold, under the accrual method, even if you're a cash method taxpayer. Cash method taxpayers can use the cash method for non-inventory accounts. No problem there. And the technique is called a hybrid method for cash method taxpayers who are using cash method in one area and accruals in the other, in inventory. Okay. The exception, there's always an exception, right? The exception is if you're a cash method taxpayer and over the last 3 years plus the year that you're doing your taxes for now, you made under $10 million, then these rules don't apply to you about inventory. You can treat inventory just like you would any of your other cash method accounts. Okay, so if you're making under 10 million, it doesn't apply. If you're making over 10 million, then what you have to do is account for your inventory on the accrual method. UNICAP. What is UNICAP? Another acronym for us. What it means is the uniform capitalization of inventory. And what it says is inventory purchased or produced has to be accounted for using full absorption, which I already talked to you guys about. Indirect costs are allocated to the inventory. They're not expensed. They have to be capitalized. So what we're saying is if we've got a lot of inventory, we're not going to be able to take indirect costs as expenses. We got to capitalize it. And then except for costs of selling, advertising, and research, we don't have to capitalize that. And again, there's an exception for small businesses. UNICAP, okay? Full absorption rules apply to UNICAP. Okay, and this one is really old news for you, so I'm not going to go into it at all, but inventory flow assumptions, we all know FIFO, LIFO, and specific identification. You guys are experts on that, and I won't delve into that anymore. Okay, when you talk about accruing business expenses, all events test, again, if we want to take business expenses, all events have occurred to establish the liability. We know what the amount is with reasonable accuracy, and we don't have reserves for future liabilities. Then we can deduct the expense. Economic performance as well. I kind of skirt over this because I think it really is more complicated than you guys need to have at this point in time. So I'll kind of skip through that. The last thing I want to do is talk about changing an accounting period or changing an accounting method, excuse me. accounting methods, as I talked to you guys already, I said are usually adopted by reporting in year one. You file your return using whatever accounting method you've picked. That's it. That's your accounting method. But if you use an impermissible method, in some way the IRS is going to catch you. So I'm going to assume that we're talking about permissible methods. And you want to change your accounting method, you have to talk to the IRS. If you're going to go from one to the other, it's important that you file a form asking for IRS permission. Now, it's typically one that'll happen all the time where you'll get permission. It's in a rare case the IRS says no, but I just want you to know that you have to do that. Okay, again, talking about changing accounting methods. When a business changes from one to another, you have to make adjustments, of course. When you're going, let's say, from a cash method to an accrual method of accounting for taxes, there's some adjustments that need to be made in the year that you make the change. This is called a Section 481 adjustment. It comes from Internal Revenue Code Section 481. And the reason behind the adjustment is this. If you're going from a cash method, for example, to an accrual method, what might happen is you could either duplicate income or omit expenses, but something could happen to your income and your expenses where they're either duplicated or omitted in one way or another. 481 is designed to say, okay, we're going to fix that. And how are we going to fix that? What's a 481 adjustment? So if you've got extra income in the year that you changed your method as the taxpayer, you can, if you have extra income, you get a break, and you can break that extra income over 4 years as you claim that added income on your return. So you have to claim 25% of that income every year for 4 years if you have extra income based on the 481 adjustment. Okay? If the adjustment decreases your taxable income, then you can recognize the entire deduction in the year you made your accounting method change. Now, where does it get a little confusing? It's not separate activities. It happens all at once. So let's say, for example, that at the end of last year, 2016, I had $10,000 in or let's make it easier to figure. Let's say I had $20,000 in accrued income, okay? And I had, let me make it $25,000, easier to figure in my head. If I have $25,000 of accrued income, and I'm on the cash method, I haven't picked it up in income yet because I haven't received it, okay? And I have $5,000 of expenses, and I haven't taken those either because they're prepaid expenses, so I'm not taking those either if I'm a cash method taxpayer. Well, in 2017, I decided, I'm going to the accrual method. I'm growing. I think it's a better way for me to go. I need to do a 481 adjustment. I don't take that $25,000 of income and just divide it by 4 and say, okay, that's that, and then I'm going to take this whole expenses, $5,000 of expenses this year in 2017. What I do is net them. So I've got $25,000 of income that I haven't picked up yet. I've got $5,000 of expense that I know I can deduct this year. $5,000 off of the 25, I've got $20,000 left. I divide that by 4, and so what do I come up with? $5,000 of income every year, additional income that I have to show on my tax return. And that's a 481 adjustment, okay? Hope that's clear. Remember, as always, if you guys have questions, let me know. But that's pretty much it for Chapter 9. And so what we'll do next is we'll move into the next one. We'll be talking about Chapter 13. But again, you guys, if you have any questions, let me know. But I want you to get the concepts. I don't want you necessarily getting lost in the weeds. Okay, take care. Bye-bye.